Hey everyone, welcome to Tax and Accounting Tips, short videos designed to get you a bigger tax refund, protect you from loss, or just give you peace of mind should the IRS come looking for you. You've done things right. If you're self-employed or a small business owner, you can benefit from employee retirement plans, the same as large corporations can. In this video, we'll break down 5 retirement plan options for small businesses. 1, a SEP IRA, 2, a simple IRA, 3, a solo 401k, 4, a traditional 401k, and 5, a Roth 401k. Let's start with the SEP IRA. The SEP stands for Simplified Employee Pension Plan. It can be used by the self-employed and small businesses with any number of employees. With the SEP IRA, contributions are made by the employer up to 25% of an employee's compensation, and the employer is required to contribute to all eligible employees, proportionally that is. The bad thing about this type of plan is that employees cannot contribute out of their paychecks. That's why you normally don't see this type of plan used if you have employees. On the other hand, if you are self-employed and you're by yourself, no employees, you can contribute up to 20% of your company's profit towards your own account, topping out at $57,000 for 2020. Not bad. The $57,000 contribution is a deduction, and it can save you a lot in tax money. SEP IRAs are easy to establish and maintain, and they are no annual reporting requirements. Also, if you have a business with variable income and want more flexibility, you should consider a SEP IRA because you're not required to contribute to the plan each year. The next type of plan I'll talk about is called a simple IRA plan. The simple stands for Savings Incentive Match Plan for Employees. Simple IRAs are available for businesses with up to 100 employees. With this type of plan, employers have to match each employee's contributions that they take out of their paychecks, dollar for dollar, but, and this is an important but, only up to 3% of the employee's total compensation. So say you have an employee who makes $60,000 a year and they're a good saver. They contribute the maximum allowed for 2020, which is $13,500 out of their paycheck. You, as the employer, thinks, ouch, I'm going to have to match that? Well, no, you don't, because you only have to match what employees contribute up to 3% of his or her pay. So you can never get killed as an employer. $60,000 times 3% is only $1,800. So in this case, that's what you would match, not the whole $13,500. So from an employer's standpoint, that's a nice feature. Simple IRA plans do require a little more effort to maintain than the SEP IRA plans. And of course, fees add up, costing you as far as administering the plan. But it's not bad. You don't have to file a tax return, just like a SEP, you don't have to. But in a simple, you must provide an annual employee notifications. So if you have employees or plan on having employees in the future, you want to enable your employees to contribute to their own plans, a simple IRA plan is for you. The next plan is a solo 401k plan. A solo 401k is for self-employed or business owners with no employees, kind of like a SEP. But if you have a spouse who is an employee, they can be included in the plan. With the solo 401k, business owners can make contributions both as if they are an employee and an employer, which maximizes the retirement contribution that they can make. The formula for this allowed contribution is 25% of your profit plus an additional $19,500. The limit on total contributions is $57,000 for 2020. But remember, your employee's spouse can contribute too. So if your spouse is an employee, you can easily sock away over $100,000. Of course, you have to have the earnings to do that. The plan requires more effort than IRA plans because you have to file a tax return for it each year. And you'll have to you'll probably have to go to a pension specialist to get that done. Solo 401ks are best if you have no employees other than your spouse, and you want the highest possible contribution. Avoid this plan if you intend on adding employees in the future. Next is the traditional 401k plan. A traditional 401k plan is an employer-sponsored plan for companies with employees. Employees who can contribute up to $19,500 in 2020 out of their paychecks, and the employer can contribute up to 25% of the employee's compensation. The general limit on total employer-employee contribution for 2020 again is $57,000, or 100% of the employee compensation, whichever is lower. There are more steps and costs to implement this type of plan. You must track employees and employer contributions, earnings, losses, investments, expenses, and distributions to fulfill the annual reporting requirements. Therefore, this type of plan is for larger companies with the financial ability to outsource the management of the plan. Finally, there's the Roth 401k plan. This plan is similar to the traditional 401k plan with one major exception. Contributions by employees are not tax deferred but are made with after-tax dollars. You don't get the feel-good deduction up front. But income earned on the account from interest, dividends, or capital gains are tax-free when you withdraw the funds someday. Well, that was a quick summary, and I know tax aspects of retirement plans can be very complex and confusing. If you'd like advice on about which retirement plan is best for you and you and your business, contact our office for more information. Thanks, and have a great day.